policy, particularly of Scott Bessent, is to try and cap yields and to keep yields down. And that's why I think they actually want, despite what is happening now and maybe what they've been saying, a firm to strong dollar. I think that builds in. They certainly want oil prices lower, and they want to try and keep inflation controlled. So I think that's really the focus very much. So I'd certainly think looking in the bond market is important here.
Michael Howell, CEO of CrossBorder Capital and also author of both the book and the Substack by the title Capital Wars. It is so great to welcome you back to the show and great to see you as always, Michael. Thank you so much for taking the time to join me today.
Great pleasure, Julia. Looking forward to it.
I am too. And this audience loves having you on, Michael. The last time we recorded was in November, right after the election. We were talking about where we are as it relates to global liquidity within that cycle. We were talking about 2025, that maybe we'd even experience a bit of an air pocket. So let's kind of step back and let's talk about the big picture, where we are now that we're into 2025 with the Trump 2.0 administration already, almost 2 months at this point, or well into their administration at this point, a lot happening, markets, a lot of reaction in markets, a lot of chatter about where's the economy headed. As a lot of folks know, you look at the world through global liquidity. That's such an important variable as it relates to asset markets and the economy. So let's just get where we are today. And as you know, Michael, you can take all the time you need to set the table.
Okay, well, what we focus on, as you know, is the global liquidity cycle. There's a chart that you can view, which is basically illustrating where we are. That liquidity cycle is still moving upwards. One's got to say, it bottomed, two and a bit years ago in October of 2022, and it's still effectively going up. Although, if you look closely, you'll see there's the beginnings of an air pocket in liquidity, and that's really been the problem that markets are currently facing. And that air pocket kind of began in late 2024, really for two reasons. One of the reasons, which I'll come on to, is that China was tightening its monetary policy. And China was being forced to tighten essentially because the yuan currency was basically very weak against the then resurgent US dollar. Things are a little bit different as we speak today, but effectively that was forcing the Chinese to tighten monetary policy. And they did that with great gusto. So there was a big squeeze that went on in China. They hit the economy very badly around the turn of the year. The other thing that's been going on is that the stimulus, or let's be clear here, the hidden stimulus that was imparted onto the US economy by Janet Yellen and Jay Powell, seemingly in cahoots, as Scott Bessent has suggested, to try and get Biden reelected, is starting to fade now quite significantly. And I want to start with that because I think it's an important element to understand, and it may explain quite a lot in terms of how markets are moving. So this chart that you can see, which is got the long title, but it's looking at the actions of the US Federal Reserve and the US Treasury. And it's basically talking about what we've dubbed not QE and not yield curve control. Effectively, what both agencies were doing were injecting liquidity when they were sort of protesting that they weren't. And let's just understand what's going on. The cycle that you can see shows this sort of, if you like, hidden or latent easing and tightening, or this cycle that's being imparted on financial markets. And at the peak in early 2024, that stimulus was as big as about 6 trillion. Now, that's not pure liquidity per se. Think of it as a wealth effect, and that may have a multiplier on the real economy of some fraction of that. So it might be a 0.2, a 0.1, or whatever multiplier, but it's clearly a positive stimulus. And it was really coming through for two reasons. The orange area is looking at what the Federal Reserve was doing, and this is basically injecting liquidity outside of the headline QT, quantitative tightening policies. Now, quantitative tightening have been defined by this Fed, and I stress this Fed, as meaning letting Treasury securities roll off the balance sheet. If you go back to the days of Bernanke was much clearer that it was all about liquidity and bank reserves. So if you look at it in terms of the Bernanke lens, you'd say the Federal Reserve has been easing for much of the last 2 years. If you're looking at under their lens, they've been tightening. But in fact, the reality is what the market is seeing is more liquidity. And that liquidity, the orange area, was largely coming through the rundown of the reverse repo program, which, without getting caught in the weeds, is basically an injection by the Fed into US money markets. The other element, which is the red area, was what Janet Yellen was up to at Treasury. And basically what she did, very cleverly perhaps, is to skew issuance of US debt towards the bill market. Now, since the beginning of 2023, on our reckoning, something like about 2/3 of all funding of the deficit has been through bills. That is an eye-wateringly large and a reckless amount of bill issuance to undertake. And the reason it's reckless is it basically means that the funding costs of the US government are very, very sensitive to short-term rates. It also means that Scott Bessent this year will have the task of refinancing about 30% of the entire US Treasury debt outstanding, which is a big task, and I can see he's not looking forward to that. But those two elements are important. The fact that there was bill finance, again, without getting caught in the weeds, is that a bill is a lot more liquid than a coupon security. In other words, a 30-year or a 20-year or a 10-year Treasury. And what's more, banks are very, very big buyers of bills. Banks like bills because they match banks' deposits in terms of duration almost exactly. So there's a lot of bank buying of Treasury bills. Now, Milton Friedman, the celebrated monetarist, would be turning in his grave at that prospect, because if the banking system is buying Treasury debt, they are by definition monetizing the deficit. And that can only mean pressure on inflation in the longer term. It helps asset prices maybe near term, but it certainly leads to longer term inflation from our experience of history. Now, what you see in those two elements, the orange and the red areas in the chart, is that at the peak in early 2024, there was about 6 trillion of stimulus, as I said. That's now dropped rapidly away to under 1 trillion. So that effect is clearly dragging in the economy, I would argue, dragging down on the economy, and it's causing the economy to see a slower growth period. That may be, paradoxically, to the advantage of Scott Bessent, because the bond market has reacted and yields have fallen away, which helps his funding position. But it can't be good news longer term that this stimulus is coming out. So I think that's one of the reasons the market is starting to sell off, because that liquidity impetus is coming out and is having a deleterious effect on the US economy. So that's part number one. Now, part number two is what the Chinese were doing. And also, just before I get there, I'm going to point to this chart, because this is something which, again, is somewhat arcane, but it's actually a really, really important point. And this is showing the tensions currently in US money markets. Now, this is measuring the spread between SOFR rates, which are repo rates, and Fed funds rates. And the two tram lines there are showing the sort of normal range that you'd expect for those two rates. And we're monitoring here the spread. So if you see that orange line moving above the top tram line, it's saying that spreads are blowing out. Repo rates are trading well above Fed funds, and it's indicating there's a shortage of liquidity within the system. If they're trading below that line, then what you've got is better liquidity conditions. So the fact is that if you look at the math behind that chart, what it's saying is that since the beginning of 2024, something like 60% of all those increases in the spread, jumps above the tram line, have occurred since July of last year. So you've seen this concentration. More and more days we're seeing the spread blowing out. It's telling us that liquidity is beginning crimped. It's starting to get crimped. And it means that the Federal Reserve has got to act formally in the next few months to end QT and hopefully go to a QE policy. Will they do that? That's in the lap of Jay Powell and co. The other point to note is what's happening in China. Now, this chart is a particularly important one to understand, because what it's looking at is the black line is a measure of daily GDP growth in the world economy. Now, that daily GDP is a measure that we put together that comes from an AI-based system that looks at commodity markets, it looks at trade-sensitive currencies, it looks at credit spreads across the world. And what it infers from all that data on a daily basis is what is the tempo of the world economy in terms of GDP growth. Now, we can back up one or two slides to show that in terms of highlighting the charts. And this is looking at a narrower window than we just saw. I'll come back to the other chart, but this just tries to emphasize that if you look at the growth rate, the implied growth rate of the world economy, since October of last year, what you can see is that growth suddenly took a step down through December, and then took another step down basically through January, February. And what you're seeing now is a significant slowing in the world economy that is starting to be picked up by, in terms of economist narratives, and it's starting to be seen in some of the data, viz. The latest ISM survey, etc. And what you're seeing here is not a recession, but a slowdown in growth. Now, come back to my other chart. This is looking at that same data series in black over a much longer time horizon or time scale. And the orange line that we put on top of that and advanced by about 6 weeks is Chinese liquidity injections by the Chinese People's Bank. Now, you can see the history, and what that shows is a lot of the gyrations in the world economy have been caused by changes in Chinese monetary policy. Well, in a way, that's not surprising. The People's Bank is the main driver or controller of the tempo of the Chinese economy. And the Chinese economy has such a large footprint in terms of its industrial size in the world markets that China will clearly affect the world economy. And you can see that those gyrations are unfolding, and it looks as if we've hit this air pocket largely because China has been tightening, and it's been tightening because the yuan has been weak against the strong dollar. But if you look at latest data, you'll see there that it's picking up quite noticeably. And therein lies a story, because it looks as if the Chinese are beginning to ease policy. Now, the first sign of that is looking at the Chinese bond market. Bonds never really lie, and bonds are really important for investors to monitor because there's a lot of information in the bond market that one can extract. This is looking at the 10-year Chinese government bond, the orange, against its the dotted line as a trend. And you can see that dived in the back end of last year. Yields collapsed, in other words, bond prices went up. And the reason for that, as the black line, which is the term premium, is confirming, is there was a big demand for safe assets in China. Why? Because the PBOC was tightening, and they were just, if you like, doubling down on debt deflation, and the economy was weak. People wanted safe assets. Best safe asset, government bond. So people dived into 10-year government bonds. Yields plunged. People were getting concerned about more deflation. But look at what's happening now. What you're seeing is a rebound in those yields, and the term premium has started to pick up. On top, the Chinese stock market has begun to rebound. Now, albeit that's concentrated in technology names, and it may have been triggered by DeepSeek, but I think there's something more fundamental going on. And I think the two fundamental factors that are underway is, number one, there seems to be a change in the character of Chinese economic policy. And it may be a significant one. Xi Jinping made a speech about 2 weeks ago, which was promoting capitalism, completely against his prior narrative. And what's more, Jack Ma was in the front row. So that seems to be symbolic. And the Chinese like these pantomimes, if you like, or these sort of soapboxes of actually explaining policy in these, very, maybe very obvious terms through the media. There was a previous episode several years ago, in fact, being in financial markets for a long time, I do remember that, was back in 1992 when his predecessor, Deng Xiaoping, the then Chinese leader, made a celebrated southern tour of the capitalist states in China in the southern region, which are the regions that was very very pro-capitalist. And one of the things that Deng Xiaoping then said is to be rich is glorious, and that was espousing capitalism. And it was basically a launch pad for Chinese capitalism, strong economic growth, and a strong market. Now, I'm not saying it's happening again. I'm saying watch this space because it may be. That's what's going on. Second thing is look at the daily liquidity injections by the Chinese People's Bank into the market. This is daily numbers, and you can see there is some trend seemingly emerging. Now, if that's not apparent, what we've done is on the next slide, looked at the People's Bank's balance sheet, which is shown here since, maybe over 10 years of data. But it's monthly data, but it shows, if you look closely, a big spike occurring in January and February of this year. And the red line is a 6-month annualized change. The black area is Chinese open market operations. In other words, their domestic liquidity actions. And what they seem to be doing is injecting liquidity. Will it be sustained? I don't know. If it's sustained, it's really important. And what this is basically saying is the Chinese economy is beginning to gear up again. That will be really positive for commodity markets and the world economy if they get that going. But there are clearly questions one needs to ask. So that's the liquidity story brought up to date.
Amazing. And we love the charts, Michael. I know this audience loves anytime we get to do a deep dive into the charts. Okay, I want to bring it back here to the US. You mentioned, the bond market is so important. And it sounds like Treasury Secretary Scott Bessent, he has his work cut out for him, as you pointed out, his predecessor issuing so much of that debt at the short end with the bills. That was interesting, 30% in bills. And there's been this hidden stimulus. So can I get more of your take on what he's trying to do as it relates to the bond market? Is it getting those yields down at the higher end of the curve? What are some of the implications? What are the challenges? What are even the opportunities as well? Because we have a serious debt situation here.
Yeah. Okay. I mean, let me just get those numbers right. He's got to refinance about 30% of the debt, which is about $9 trillion. And recently, build finance has been contributing about 2/3 of the deficit funding. So I don't think he's going to change those parameters significantly, but he's got to refinance in the next 12 months about $6 trillion of bills at about $3 trillion of coupons. So it's a big ask. Make no mistake about that. Now, I think what that's really telling us in a lot of ways is that the bond market is almost more important to Trump 2 than the stock market. Stock market was important in Trump 1. Maybe the bond market is important here. And I've long thought that really the focus of policy, particularly of Scott Bessent, is to try and cap yields and to keep yields down. And that's why I think they actually want, despite what is happening now and maybe what they've been saying, a firm to strong dollar. I think that builds in. They certainly want oil prices lower, and they want to try and keep inflation, controlled, which basically means, which will mean that funding costs are actually kept low. So I think that's really the focus very much. So I'd certainly think looking in the bond market is important here.
What if you can grow your gold so you're not just preserving, but you're growing your wealth in an asset that can't be inflated away by money printing? Monetary Metals lets you do just that. You can earn 3% on gold, paid in gold in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even as high as 19%. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. Okay, that's interesting though. The focus in Trump 2.0 being more on the bond market versus the stock market. Is that what we're seeing play out here right now? I'm curious, maybe more of your take on what we've seen in the markets in the last, week and a half or so.
Well, I think maybe. I mean, I think I think that if we're looking at how the world is reshaping, and these are sort of, cathartic changes we're looking at. And, I was listening to another podcast earlier, a British one called These Times, which was actually talking about the parallels between what was happening in the early 70s and now. And it was saying that if you examine Congress, there were a lot of bills that were proposed that were basically attacking the Europeans for sort of having their cake and eating it, and running a surplus with America, and also hiding under the American defense umbrella. Now, this was early 70s, okay, not now, but clearly we're back in the same same discussion points. But that was the period of Nixon, and maybe we ought to be thinking of Trump like Nixon. I mean, they're basically mold breakers. And what did Nixon do? He opened the door to negotiations with China, or maybe that's what Trump's doing with Russia. Nixon changed the monetary system. He basically ended Bretton Woods 1 and took the US off gold. Maybe this is what Scott Bessent is talking about when he's sort of talking about these momentous changes in the US balance sheet to the benefit of Americans, by saying that maybe this is the implications they revalue gold or some other assets on the balance sheet. So I think that what we could be seeing here is a significant change. Now, what's more, if you then start to embrace some of these remarks of Donald Trump, I mean, why Canada? Why Greenland? Why Ukraine? I mean, this is resources what we're talking about here. If you're in Australia, watch out. Maybe the president is now going to start looking towards Australia as another fiefdom. But I mean, ultimately, this is saying that it's real assets that are becoming more important. And if there is a refocusing of the monetary system, maybe what we ought to be thinking here is starting to think again about financial assets and start to move more towards real assets. And maybe it's things like gold and commodities, which are going to benefit a lot more under this administration than maybe people have been thinking. And certainly if you join the dots and say, well, look, Germany has just taken or trying to release the debt brake here. It's going for massive spending on infrastructure and on defense. And let's widen that out and say the whole of Europe is going to have to start spending huge amounts on defense and resources. Then you're looking at a world where commodity prices could be substantially higher.
That's an interesting point too, this move into more real assets, as you point out, like commodities. I know in the past we've talked about within the liquidity cycle, I mean, you talk about like where you kind of want to be or what assets are benefiting. You kind of used to show, I don't know if you have it with you, that more of like the traffic lights for certain asset classes. Maybe we can talk about that.
So basically, what we're trying to say on this is if you look at asset allocation, which is shown in terms of those traffic lights on the left, it all depends on the regime that we're in. Are we in a rebound phase, a calm phase, a speculation phase, or a turbulence phase? Now, if you look back at the prior chart, and I'll come back to the traffic lights in a second, this is saying where is the world? And this is the breakdown of markets into each of those different areas. Now, turbulence is the red, so that's the red traffic light. That's a period where financial markets perform badly. And what we're showing here is the percentage of markets that are in each regime. The green are the go periods, and that's calm, which is the brighter green, or the rebound, which is the lighter, paler green. And those are periods where, risk assets tend to do very well. Technology does well in the pale green area. Things like mid-cycle financials in particular, for example, tend to do well in that brighter green area. If you're moving more into the speculation area, the orange, now the US is very close, or if not in that area, that's when commodity markets tend to do pretty well. So that's what we should be expecting. But what I'm saying is that maybe on top of the cycle, we should be looking as well at the trends here. And maybe the trends are compelling. And what we're going to be seeing is, a serious upward move in commodity markets. Now, if you come back to these traffic lights, what this is really saying is, and if you look at the right-hand side on the sector implications of each of those regimes, there's one area which is labeled energy. Well, let's think about energy stroke commodities, because it's really the resource area I'm trying to indicate here. But what that's saying is that in the calm speculation phase, particularly later cycle, you tend to find that commodity markets tend to be good, commodity resource stocks tend to be good. But what I'm saying is that, there's a lot of uncertainties going on. Evidence, the fact that I was talking to a major family office earlier who were very concerned, having witnessed the last 2 months or month and a half of the Trump administration, where they're going to put their assets. And one of the key considerations they have is, what about the integrity of custodians? It could well be that Donald Trump, with sort of Nero's thumb up down, suddenly dislikes one bank or another custodian, and things go wrong. So these are the considerations that people need to have. And my view was, well, you've got to start diversifying more and more into real assets, and particularly gold. And maybe gold in a Swiss bank in Switzerland would be a pretty decent investment to have in what is an uncertain world. But ultimately, I think commodity markets are going to start to pick up more significantly. Now, what is going on, right now in terms of investors' risk exposure? This is a chart that is maybe not precise, but I think it tells us quite a lot about what's going on. And this is looking at the risk exposure of investors globally. Now, the way to read that chart, to look at the orange line, is to say that 0 is a normal asset allocation between stocks, fixed income, commodities, cash, etc. And if you start to move lower on the page, what you get is a bigger allocations to safe assets. So 0 is neutral, and those readings of sort of plus 20, minus 20 refer to standard deviations. So 20 is one standard deviation, etc., away from the normal level. Now, we've superimposed a sine wave that gives some sense of sort of a 9 to 10 year cycle. But what that's basically saying is, whatever one says about the sine wave, is that the orange line is going down. So investors are taking risk off the table. They're getting more nervous. And that's something to be very cognizant of. Despite the fact that liquidity is decent, investors are not really reacting to that liquidity. They're starting to become a lot more cautious. The world may be changing in that regard. So, liquidity is one big factor, but also the risk positioning of investors is another one that we've got to take into account.
Yeah, it's interesting. Just looking at like the risk appetite coming down. Michael, you've made some prescient calls over the years, especially looking at the liquidity cycle. That's why I think this audience really loves having you on, because it's always so fascinating. You mentioned that we could be in a bit of an air pocket. I know you said that liquidity is still going up. We're still trending upwards, but we could be in this air pocket. What could cause it to change and go in the other direction? Or how do you know when you're kind of out of an air pocket and you can get more clarity as to like where it's headed?
Okay, well, let me come back to maybe a little bit of the dynamics of liquidity, and I can answer your question using these slides. So this slide that you're looking at right now is looking at a heat map. It's actually end January data. We're just compiling the end February now, but this is not going to change dramatically. What you can see here is a shift of central bank policy. And this is not looking at interest rates. This is looking at their liquidity injections into markets, which is a lot more meaningful. And what you're seeing here is a graduation, a change in those hues from red towards green, yellow, green, orange, or whatever. And we're seeing a move from tightness on the left towards ease on the right. So central banks are still adding liquidity into the system. And if you look at the liquidity cycle in terms of rate of change, the orange line is basically depicting that picture. Now, what you can see on the chart is a dotted line, which is our extrapolation of what liquidity does over the remainder of this year and into early 2026. So we think it's still going up, it's still growing, but the rate of growth is beginning to roll over. And the black line is the performance of all asset markets worldwide. So that's stocks, bonds, all bonds, corporates and governments. It's liquid assets, it's cryptocurrencies, precious metals, and it's even got residential real estate in that series. So what you can see is that global liquidity matters hugely to asset prices. The two move pretty much together, and that's why we're very much focused on it. Now, in terms of where we are now and where we're going, you'll see that there is an air pocket in that liquidity line. It dips down sharply before it picks up. And that is already being illustrated in the price of Bitcoin. This chart, which is maybe worth just dwelling on for a moment, is looking at our weekly global liquidity series, which is the black line. And the orange line is the price of Bitcoin in terms of 6-week changes. Now, is there anything magical in 6 weeks? No, we've just chosen 6 weeks because it's convenient filter to get rid of the noise in the data, and it gives us something more substantial to try and model. The global liquidity line is shifted forwards by 13 weeks. So it seems as if global liquidity leads Bitcoin by about 3 months or there or thereabouts. And, we've been foreshadowing that this air pocket is due, but you can see from the data that the black line picks up again. And lo and behold, we're starting to see better signs from liquidity right now. Why is that better liquidity coming through? Number one, China is adding liquidity, as I said. Number two, the bond markets have rallied, and that's improved collateral and bond volatility. The MOVE index has dropped down. The dollar is lower, and all these things contribute. So that's helping for a cyclical pickup. Now, looking beyond this, which I think is the important thing, is could we see a much, much bigger move, either up or down in the liquidity cycle as a result of what Trump too is engaged in? And I alluded earlier to the fact that the Chinese are easing. Now, the real question that we need to pose is, what is the ability of China to keep easing while at the same time maintaining the integrity of the Chinese currency, the yuan, against the US dollar? Because the more they ease and the more that, or the less that the Fed does, the more chance the yuan has got to devalue, and that would not be what the Chinese apparently want. Now, my view is that the Chinese have to devalue their currency to get out of their debt problems. So they have to print liquidity. Let's hold that thought and try and run with it. If the Chinese need to devalue, what do they need to devalue against? Well, it isn't necessarily the US dollar, actually. In fact, they're running a whopping great trade surplus with America, so one can argue their currency is competitive against the paper dollar. What they really need to devalue against is real assets, because they've got a whopping great debt problem. So they need to get the paper value of their debts down. So in my view, they need to devalue against a real asset like gold. And the calculations that we put forward before, looking at the metrics, were that China had to devalue by about 30%. In other words, they've got to print about 30% more liquidity. The rationale for that is that what matters in a world of debt is not your debt to GDP ratio, which is a completely nebulous statistic that economists have thought up because it's convenient and they can measure it, to something that's more practical. Is if you've got to refinance debt, you need liquidity. You've got to have liquidity to get the roll. So it's debt to liquidity ratio which is critical, not debt to GDP. And if you look at the debt to liquidity ratio in China, it means that liquidity has got to increase by about 30% to actually get back to an equilibrium, which means a 30% devaluation of the yuan, but importantly, a 30% devaluation against gold. So in fact, the yuan gold price, which is currently about 20,000 yuan, needs to go to at least 26,000, which is a big change. Now, China is maybe positioned for this already because they're accumulating vast amounts of gold, as we know. What about the US? Well, currencies triangulate. So if the yuan goes to 26,000 and the dollar gold price doesn't change, then what you've got is a big devaluation of the yuan against the dollar. That won't be acceptable. So what we need to see is the dollar gold price going up pari passu. So that would mean that if the yuan goes to 26,000 yuan per ounce of gold, the US dollar equivalent would have to go to 3,600 US dollars per ounce. Okay. Is that feasible? Well, actually, funnily enough, that fits in exactly with the discussions or the implications, let's say, of Scott Bessent saying we've got to revalue US assets for the benefit of Americans. Well, what's on the US balance sheet that he could revalue? Okay. I reckon there are three assets. Gold, which is being currently priced at 42.22 per ounce, courtesy of a 1972 decision, where it hasn't changed since. The only other country I know of that doesn't revalue their gold is Japan. All the other major economies revalue. The Europeans quarterly, the Chinese allegedly monthly. So America could step up and join the convention here. The other assets they've got are Fannie and Freddie, the GSEs, the mortgage banks. Well, that's quite feasible. They could do that. And that's been touted, so why not? The other is US real estate, which means the Parks Department. Well, good luck there. And the other is US military bases. But you can't really revalue those. They don't really have a worth in the private market. So the only things he can really seriously do would be Fannie and Freddie and the gold stock. And I reckon this actually fits in pretty well with what their thinking could be. So I wouldn't rule out some change going on here. And if the gold price is revalued, then you've got a significant step up in commodity prices generally. It's a big monetization. Not only would that happen, but the Treasury would get a windfall gain of about $1.25 trillion, which would mean a lot less bond issuance over the next few years. And that's clearly something that Scott Bessent will be rubbing his hands at. Now, if you contrast that picture with what's going on in Europe, the Europeans are going to start issuing a ton of debt. And just look at what's happening as we speak to the Bund market in Germany. Yields are starting to spike upwards because of the threat of this increased debt load on Europe. Europe ain't in a good position looking forward. America could come out of this really quite well.
Interesting. Yeah. The gold part, the revaluing the gold's really interesting. Also, the Fannie Freddie bit, if they can get that to move out of conservatorship. Those are two topics that are very popular on this channel. On the gold part, though, since that is something that folks care about, let's say they do revalue the gold that they have, and it is a windfall. What are some of the implications that you might have to think about from an investing perspective?
Well, I would say buy more.
Buy more gold.
Buy more gold.
Yeah.
I mean, the reality is that, most investors have got very low positions in gold, very small positions. When I first started in the markets, in the early 1980s, I mean, an age ago now, but it was quite common for a lot of private banks in Switzerland to have at least 15%, say at least 15% of their clients' wealth in gold. I mean, that's now down to probably less than 1%. So, the world changes. And gold is a very good hedge against monetary inflation. Now, are we getting monetary inflation? Well, you bet, because there's this huge amount of debt that's got to be financed somehow in the world economy. We are now we're in a huge indebted world. And the only thing that politicians can do is effectively kick the can down the road. So there's no way that there's going to be a debt jubilee or anyone paying back this debt. It's effectively, going to be monetized over the longer term. And you look at this statistic, which I think is a very good one, or a prescient one to think about looking forward, is that since year 2000, the stock of US Treasury debt in the market has gone up, if my calculations are correct, 9.6 times, since year 2000. The gold price has increased in value by 9.6 times. Well, that must be more than coincidence. Gold has basically matched the increase in US debt because that's inferring a longer-term monetization, and gold holds its worth. Gold is a hedge against monetary inflation. It's not necessarily a hedge against high street inflation, but it's definitely a monetary inflation hedge. And that's what it's proven through, thousands of years of history.
Yeah. One of the things I've learned from conversations with you, Michael, is, when you look at the debt situation globally, even like with our capital markets, so much of it is to like refinance the existing debt, kick the can down the road. As someone who's looked at this stuff for a long time, do you see a way out of our massive debt burdens? Is there a path that's, not super, I guess it's going to be ugly no matter what. What's the pathway out of all of this? Is there one?
Well, the obvious one is to renege on Social Security and Medicare obligations.
That would be awful. Yeah. I don't know.
That's infeasible.
Yeah.
That would be dismantling the European welfare states. Is that feasible? Unlikely. Mm-hmm. So unless they do that, the debt burden is going to grow and grow and grow. It's very difficult to keep taxing populations, particularly in the current world, because the people who are the entrepreneurs sugar off somewhere else. They go to America, they go to Australia, they go to lower tax environments. And Europe, for example, which is a high tax area, loses more and more wealth creators. And that clearly is unsustainable. So they can't tax. They've got commitments on spending. Therefore, the only way to fill the gap is to print money. And the problem that the Europeans are facing right now is they've got a whopping great debt burden. I mean, they've been avoiding defense spending for way, way too long, as we know. They're now coming up to the crunch. I mean, nobody, I think, in Europe seriously, or the politicians seriously believed that America would take away the defense umbrella and maybe move out of NATO. That was unthinkable. But I mean, the politicians should have had some contingency plans, because this is becoming a reality. The fact is that they're going to have to fork out now massive defense spending, and that will mean must be more bond issuance, mustn't it? I mean, that's all they can do. Now, the problem comes is you may get, if you recall what happened in Britain in 2022, a Liz Truss moment. And that is when the bond markets bulk at increasing financing and yields gap up. And that's why I'm saying that in that sort of world, actually, the US is in a pretty good position, because you could have this windfall gain enabling the Treasury to slow or even stop coupon issuance because of the revaluation of gold, at the same time that the Europeans are having to come into the market big time to afford their new defense bill. So this is a position where the US is clearly in a situation of great strength potentially.
Mm-hmm. Yeah, it's a good point. Like, we all have debt problems, but the phrase that gets tossed around is like we're the cleanest dirty shirt in the laundry pile. But it's a global issue as well. When you and I spoke back in November, we talked about 2025 being a challenging year. Is that still a fair characterization from where you sit as an investor? How are you thinking about the year ahead? Is it going to be more challenging than usual? Just more curious for your outlook.
Yeah, I think it is. I think there were. I mean, the original statement about 2025 being a more difficult year really came from two observations. And one is the liquidity cycle has a normal frequency of about 65 months, which would suggest that it would begin to inflect anyway later this year. So that's clearly one warning. And the other one is if you look at what is termed the debt wall or the debt maturity wall, that's another factor that's really coming in from about middle of 2025. And the debt maturity wall refers to the refinancing of all the debt that was issued really through the COVID emergency years when interest rates were low and investors termed out debt to 25, 26, 27. That debt is now coming due. So there'll be a big load on markets. Was demands for liquidity for rolling over debt. And if money is being used to roll over debt, it's not being used to buy technology stocks or Bitcoin or whatever. And so you will face a challenge. Now, that challenge will clearly go away if the Federal Reserve steps up and starts injecting liquidity. The problem is that the Federal Reserve is showing no inclination to do this whatsoever. It may be, and I don't know, I mean, I'm not an expert on the internal workings of the Fed, but we may have a very political Fed. And it seems, I don't know, from an outsider's point of view, maybe more than coincidence that the Fed was cutting interest rates with alacrity right up to the election. And since the election, they've started to sit on their hands a bit and worry about further rate cuts. So that may be something they're factoring in. And what's more, from my perspective, it's pretty worrying that they are not saying anything about how they expand their balance sheet going forward. And the maths come down to the fact that the banks will be challenged in terms of a lack of reserves on our reckoning about the middle of this year, about mid-July. Now, what that really means is that looking at the money markets, there's a lot of demands coming out of the money markets. One would be the big tax payments that are due in April, which may be sizable given the gains in the stock market last year and the strength of the economy. So April could be a big tax month, which means money coming out of money markets and actually going into the Treasury general account. So that could pick up. You've also got the prospect that there'll be more coupon issuance later in the year, etc. And ultimately, what we can see are signs that effectively money markets will start to flag, if you like, or bank reserves will drop below minimum levels on our estimates sometime around about the middle of this year. So in other words, the Federal Reserve has got to be active and got to expand its balance sheet. All this talk that policymakers make about reducing the size of the balance sheet, getting it back to normal levels, whatever that means, is absolutely fanciful. I mean, either they're delusional, or they're not effectively speaking the truth. They're hiding what they're really doing. But they have to do this because of the debt burden that's out there. You can't gauge the Fed's balance sheet relative to history or what we're used to. You've got to gauge it relative to the debt burden that's out there, because the Federal Reserve is effectively controlling the speed or the ability of the system to refinance debt, and it needs a bigger balance sheet.
What do you think the Fed will do? I mean, this year we have a Fed meeting coming up. Do you think we'll see? Do you think we will see more rate? Do you think we'll see rate cuts? What is more of your thought process on?
Well, I think in my view, or my world, rate cuts matter a lot less than the size of the balance sheet. It's all about liquidity. That's really the critical thing. In a world which is dominated by debt refinancing, which is the world we're in, let's face that, you need balance sheet capacity, not lower interest rates. And just think of it in a sort of homespun example of a mortgage repayment. If you've got a home mortgage which you need to refinance, getting the roll, in other words, getting a lender to roll the mortgage over, is absolutely critical to you rather than the interest rate they charge. Because if they don't roll, you're homeless, okay? The same with a corporate bond. If you don't roll the corporate bond, you default, which is much more painful than paying a higher interest rate. So in a world of debt refinancing, it's the balance sheet that's really critical. Will the Federal Reserve, having said that, cut interest rates? I'm not sure. I think the difficulty is that inflation is running at a higher level now than maybe the Fed wants, underlying inflation. We've seen that from the Michigan survey. We've seen that, I think, by looking at the break-even inflation rates. They're telling us that things are starting to go slightly wrong there. So, I think the Federal Reserve, on its own criteria, would find it difficult to cut rates. On the other hand, I think they need to get the balance sheet expanded, which is a different factor. But will they do either? I'm not sure. I think they definitely need to. Now, as I sort of came back and said, if you look at the SOFR Fed funds spread earlier, that's telling us that there is a problem emerging in financial markets. And that's part of what's going on right now with the markets selling off. There are tensions. What you've got are all the signs of a liquidity squeeze, bond markets rallying, economy is slowing down, money market spreads are blowing out, liquidity sensitive assets are selling off. That's the story.
That's the story. Well, okay, that's the story. How do you extrapolate that? Is it just like right in this moment, or is that like a warning sign of things to come?
Well, I think that it's a warning sign of what could come. Yeah, I mean, this is, as we've been saying, 2025 is a much more uncertain year. Even President Trump, he's obviously throwing a spanner into the machine, and that's what he likes to do. So it's really unpredictable, as we all know. On the other hand, he's iconoclastic, and he's a mold breaker, and he is likely to change things fairly significantly. What he's going to do, I have no idea. But all I'm inferring is that an obvious win-win would be to revalue the US gold stock. Now, if he did that, that would represent a significant liquidity injection into US financial markets. And I would imagine that you would see, stock prices significantly elevated from here. The gold market would go up, pari passu as well, and you get some revival in Bitcoin. But that's a cyclical move. And what I'm really saying underneath is that may well happen, but look at the secular trends. Maybe we're in a world where, joining up all these dots, commodity markets or real assets are going to start to outperform financial assets over the medium term. And that may be, what Trump 2.0 is really all about at the end of the day.
Fascinating. Yeah, I'm hearing a similar theme come up from folks who've been on this channel lately. One thing we didn't bring up in this conversation, Michael, is tariffs. Do you have a point of view there and how to think about tariffs, from an investing perspective? Yeah,
at the end of the day, I mean, I've long argued that, but just this in terms of observation, that tariffs are not the end game here. They're a negotiating tool. I mean, my very simple understanding of Donald Trump is, reading The Art of the Deal, where he basically, in a nutshell, says that the way you negotiate is you put everybody into a room, you throw a couple of hand grenades in, shut the door, and then go back in and say, "Do you want to negotiate now?" And the hand grenades are, 50% tariffs or whatever it may be that he threatens to impose. And then if Canada says, "Well, we're going to match your tariffs," then he says, "Okay, well, we're going to go up again." So this is a game of poker. And I wouldn't like to be facing Donald Trump in a game of poker, I must admit. So I don't know what the outcome is, but I think ultimately these are negotiating tools. And what he really wants is for FDI, foreign direct investment, to come pouring into America. And on that basis, America becomes a major producer. But it's not just American capital that's in there, it's Chinese capital, Canadian capital, European capital, etc., which is basically making the widgets and products in the US. And creating US jobs. And that's what Trump wants at the end of the day. If there was any military conflict in the longer term with China, much better to have them inside the tent, so to speak, than outside. And you can control Chinese factories if they're onshore America.
Michael, I have to say, I said this again, we love having you on the show. You always help us learn. I love your charts. I want to give you the final 60 seconds here. Let folks know where they can support your work. You have an amazing Substack. And any parting thoughts, anything that you would like to leave this audience to think about, the floor is all yours.
Sure, yeah. Well, I apologize it's going dark here, but this is actually the result of being in the UK. So it's now nighttime. So I'm sure I'm getting darker and darker. But in terms of the last thought, I think that resources are definitely something for portfolio consideration. Gold, definitely to have part of a portfolio. Buying on weakness, it's going up, I think, a lot in the medium term. And in terms of reading our work, Substack, called Capital Wars, is probably the easiest way to contact us or to read our thoughts.
Michael Howell, CEO of CrossBorder Capital, author of Capital Wars on Substack. Thank you so much for being so generous with your time, your knowledge, all of your wisdom. We love having you on. You are always welcome. Thank you again, Michael.
Thanks, Judy. Enjoyed it enormously. Thank you.
Likewise.